Getting ready for the FOMC meeting on September 20 and 21, 2016. Lenders seek good borrowers. I'm Gopalan Ramachandran, Ramach, and my email is upturnmanifesto@gmail.com. The federal funds rate, or the Fed funds rate, is now between 0.25% and 0.50%. The Federal Open Market Committee will meet on September 20 and 21 to vote for or vote against a hike in the Fed funds rate. The Fed funds rate is the interest rate that depository institutions charge each other for overnight loans. This rate responds to the decisions made by the U.S. Federal Reserve pertinent to money supply and liquidity. Loosening lowers the target rate and/or the target range. Tightening, by contrast, raises the target rate and/or the target range. Interest rates respond to the supply of liquidity and the demand for credit from families, firms, and government. Who are the beneficiaries? The federal funds rate is now between 0.25% and 0.50%. Liquidity has surged since 2008, and the near zero Fed funds rate is the result of the loosening. How have families, firms, and government been served by these very low rates? How have the low interest rates affected households and families? We need to ask this question because net, households are the principal, if not sole, sources of all savings and taxes in the economy. The near zero Fed funds rate has held back the recovery. The Fed funds rate was between 0% and 0.25% from December 16, 2008 until December 16, 2015, the 7 years of near zero Fed funds rate. What would or should the FOMC do when they meet on September 20 and 21? We have been working on this question. We have adopted a step-by-step approach. We have considered the role of equity, and we have found that equity is quirky and tantalizing. It's not the mainstay of the American economy. Why? Equity is like a magnet that needs two poles. Firms that are very likely to make a profit are attractive to us, the investors. But the incumbent shareholders and partners of successful firms will not want us in. We know why Facebook will not issue us 1 million shares, not even at the current market price of $129. On the other side, firms that are very likely to make a loss will want our equity. Their incumbent shareholders and partners will want us in, but we won't go in. We know why we will not ask Zynga, for example, to issue us 1 million shares, not even at the very low current market price of about $4. So what do we do with our savings? We need to take an empirical approach. First, investments in assets where we are the sole owners will precede everything. Examples: homes and education, non-residential investments, and consumer durables. And why? The problem of delusion does not erode the values of homes and our own intellectual capital. Second, deposits in banks and investments in bonds. Third, investments in pension entitlements. And finally, we invest in corporate equities and mutual funds. Let's look at the numbers. Here are the flow numbers. What did America do in 2013, 14, and 15? These data are from the Federal Reserve statistical release second quarter 2016, released on September 16. Title of this publication: Financial Accounts of the United States, the Z1 Report. Net acquisition of financial assets in billions of dollars. America has invested close to $3 trillion in 2015, America's households, of which the proportion of equities and mutual funds has been less than 4% last year, merely 3.1%. It was 16.5% in 2014 and about 14% in 2013. By contrast, America has invested substantially in pension entitlements, about 15% in 2015 and almost 19% in 2013. And lastly, the biggie: the proportion of bank deposits, bonds, insurance, and other receivables to the total, a whopping 82% in 2015. It was about 72% in 2014 and almost 70% in 2013. So, investments in debt continue to be significant. And what about the stock numbers? That's a measurement of all the wealth that American households own. The total financial assets of households in 2015 was $65.6 trillion. It was $60.6 trillion in 2013, of which the financial liabilities in 2015 were $21.25 trillion. So we compute the net financial assets, which was for about $40 trillion in 2013 and $44 trillion in 2015. And the total of equity to net financial assets has always been less than 50%. Read the three numbers: 46.8% in 2013, 48.3% in 2014, and 46.6% in 2015. We see some stability there, which also means that the proportion of debt to net financial assets has always been above 50%. In 2013, it was 53.2%, and in the most recent year, 53.4%. Therefore, lending is the default setting since it comes with contractual claims. The components: periodic payment of interest, repayment of principal on call in the context of deposits, principal repayment at maturity in the case of bonds, and finally, the right to repossess assets if there are any unpaid dues. And the borrower would have to cede title to those assets to the lender. The lender can sell or liquidate such assets of the borrower. Therefore, borrowers are rated for their ability to fulfill the contractual claims that are vested with lenders. Credit scores of individuals, credit rating of companies, credit rating of state and municipal governments, and finally, credit rating of the United States federal government. Therefore, we'll place these things before we complete the analysis in the context of how households have been affected. Two statements: lenders seek the certainty of debt. So do families. They too seek the certainty of debt. The US Federal Reserve has printed a lot of money. Households have allocated their new savings to contractual claims. That's debt. How much has America invested in its households? That's a question we'll be answering soon. Thank you for watching this video. Gopalan Ramachandran, and my email is upturnmanifesto@gmail.com.